Greetings. Today is Friday, September 20th, 2024. And by now you've likely heard that Chairman Powell announced earlier this week that the Federal Reserve is going to lower their Fed funds rate by 50 basis points. Now that's a larger cut than what a lot of market participants were anticipating. So does that larger cut signify that the Federal Reserve believes we are closer to a recession? Well, we're going to look at some economic data points so we can draw our own conclusions. But before we do that, I would be remiss if I didn't stop and commemorate two big events in the lives of Hicks Associates Wealth Management. First, earlier this month, Thea Nelson hit 20 years of service for me and you, for that matter. So very grateful for Thea for all the hard work that she has given us over the years. If you have her email, she would probably love just a quick note congratulating her on 20 years. Very grateful for her. Now, that said, an even bigger event this past weekend, Paul Richards got married. So the team drove out to Flat Rock, North Carolina to witness Paul and Elizabeth exchanging vows, a lovely ceremony and a lovely reception. And so, again, feel free to drop Paul a note and wish him congratulations in that. So that said, let's dive in to some of this economic data. So on the screen right now, we have the Schnepp recession indicator. You'll recall from a couple videos ago that the recession indicator noted here does so far have a perfect track record in calling recessions, and it is indeed suggesting a recession is at hand or is about to start. So the concern that we have with a 50 basis point cut, does that suggest that the Federal Reserve believes a recession is more likely to occur? Again, look at the Schnepp recession indicator, perfect track record. It suggests a recession is at hand. However, let's look at the GDP. The Atlanta Federal Reserve's GDP Now tool, which is as of 2 days ago, is suggesting that the third quarter GDP for the nation will be about 2.9%. That's positive 2.9%. By historical standards, you can't have a recession if you have GDP at a positive figure. The question is, how accurate is that GDP Now tool? Well, on the screen right now is the GDP histogram that I showed previously, and you can see this red bar over here. I added that to the chart to show what GDP was suggested, what Atlanta Federal Reserve, what that GDP Now tool was suggesting was going to happen for second quarter GDP. And then you can see the black bar right behind that it came in pretty stinking close. So the fact that the GDP Now tool is suggesting 2.9% for the third quarter of this year, that's still suggesting that the economy is expanding. So if we return to this GDP histogram, we see that second quarter GDP was positive 3%. And if the Atlanta Federal Reserve's GDP Now tool is accurate, and third quarter is 2.9%, that'll be just below what second quarter was, but still expansionary. So far, this data is not suggesting that we see a recession, at least not yet. Next data point on the screen is inflation. Remember, inflation is a measure of year-over-year price changes. So prices are still very elevated. Is it still very expensive to go to the grocery store, etc.? That is because we have not seen deflation. While all of us would like to see prices return back to where they were before this inflation started getting out of control, we have to also remember that deflation can be a very big problem in the economy. So the Federal Reserve is trying to thread a needle. But the good news here is that inflation has finally fallen back below this 10-year average. The 10-year average is 2.8. So right now we're at 2.6%. My concern is I'm not convinced that trend is going to stay in force. Why do I say that? Because if we look at gold is at all-time highs. Now that suggests that the people that are buying gold still believe inflation is a problem or inflation is going to be a problem. It also can be suggestive of economic uncertainty. So this is not a good sign. The other thing that I would quickly point out is that the M2 money supply has again ticked back higher. This is how much money, how much currency is in our nation. I would contend this right here, this is the actual problem and why we have had inflation, because of how much money the Federal Reserve has printed. They've been printing money. That's the cause of inflation, because you have too many dollars chasing too few goods. And if you understand economics, it's supply and demand. there's an abundance of dollars and there's not an abundance of goods, so the prices have been bid up. We were seeing money supply coming down, but lately it has ticked back higher, and the most recent data point, again, another tick higher. That's not a good sign. The other thing that we'll talk about briefly is the yield curve. This again on the screen, I'm showing the 10-year yield minus the 3-month yield. This is the yield curve that we prefer because Dr. Campbell Harvey over at Duke University, this is the yield curve that his dissertation was based off of, and he's arguably the one that that discovered, if you will, the forecasting ability of the yield curve. So it's been inverted now for about 22 months. That is not a good sign. Other yield curves, you might hear other people talking about that they have become uninverted. They're back above the zero line, but this one is still below the zero line. Now, if we zoom back out, we see leading up to the global financial crisis, this yield curve was inverted for 23 months. Now, again, it uninverted somewhere over here, but 23 months from the point of initial inversion to the onset of recession, it was 23 months. We are now at 22 months. So that is a concern. However, one of the things that I have consistently said, and this is true of the Schlepp recession indicator as well as the yield curve, so far, both of those indicators do have perfect track records in terms of calling a recession. But that doesn't mean they will always have a perfect track record. In my opinion, it is still entirely possible. It is entirely possible. I'm not saying probable, I said possible. It is entirely possible that these two indicators will be printing a false positive. We won't know until we have a little bit more history behind us, but that is possible. Next data point is from the Chicago Federal Reserve. This is the Financial Conditions Credit Subindex. Bottom line, look at the gray bars, and the credit index subindex goes above the zero line leading into recession. Where are we at? We are still below this line. So that is also not suggesting a recession. We'll land the plane on this. On the screen right now is our seasonality chart. September is the worst month in the stock market's year. The blue dot right here represents 2024. So September 2024 so far is well above average for the month of September. Historically, you can see the red bar, that's the average September. However, let's look a little bit further into the data, and what we'll see on top is the month of September by day. And so you can see where we're at. We're right here. So historically, September is the worst month in the stock market year, and it is usually because of the last couple of weeks in the month. So it remains to be seen how September is going to finish. Right now, we are encouraged because we see expanding breadth, and we are putting in all-time highs. The market is pulling in a little bit today. We'll see how it closes, but if you're a client of ours, by now you know we will follow price. We're not making predictions. We are not predicting. We are prepared. We're prepared for a bull market. We're prepared for a bear market. If you have any questions about how we manage money, if you'd like us to take a look at your portfolio, by all means, feel free to reach out to us. We are more than happy to see if we can't be of service. We do serve clients all across the nation. You can find more information at hicks-associates.com. Go there, click one of those big blue buttons, and one of us will be in touch. Until next time, thanks for watching, and we'll talk to you soon.